Hello, everyone. Brian Bowers from Visible Supply Chain Management. So happy to be with you today and with many members of this association that we have regular interaction with. So really looking forward to that session and the opportunity to talk with you today. Go ahead and advance the slide if you would. I'd like to give you just a little introduction to Visible Supply Chain Management. First of all, we're a comprehensive supply chain company that really is focused on e-commerce and direct-to-consumer activities, mainly fulfillment focused. So you see on the right-hand side are what we call the fulfillment wheel, but really it's our verticals that we support around fulfillment. So we're a fulfillment focused company. We have freight and logistics as a piece of our service offering, parcel as an offering, and packaging and some other ancillary services that we provide, all supported by our technology suite that's comprehensive and provides our customers real reliable and gives them visibility into their data and into what's going on. So our company, we serve large and niche retailers. Several of the members of this group are our customers. We also serve a wide range of e-commerce businesses. So we're actually an authorized reseller of United States postal rates. So we actually have placed our rates into shipping softwares throughout e-commerce. And so we have a real nice offering that we're able to provide to shippers through these shipping softwares using our rates. We provide services to direct sales companies and also subscription box providers and manufacturers and distributors, especially through our freight offering. Next slide. To give you a feel of the scale of Visible Supply Chain Management, we have 9 fulfillment warehouses across the country. We have multiple transportation offices and a corporate headquarters located in Salt Lake City, Utah. Next slide. Those facilities, when you look at the square footage, we have about 2.5 million square feet of space that we're supporting, again, mainly fulfillment clients, but we're also doing some retail distribution in those facilities. And then in terms of scale, those facilities, we actually produced 35 million packages, direct-to-consumer packages last year. And we support 200 million parcels being shipped in our network in 2020, which constitutes about $1.5 billion in transportation that's under our spend management. And so those are big pieces of our business that we're working to support our clients in getting best service in terms of carrier options and in terms of logistics solutions, and also best cost and cost savings opportunities. Go ahead to the next slide. So being based in the West, we like to think of things in terms of rivers and nature, and we have a lot of great nature around us. The state of the delivery supply chain in 2020 and 2021, I think resembles most closely a run down I'll call it the supply chain river, where we've had periods of major rapids, lots of waves, people getting thrown out of the boat, and then we've had periods of calm, and again, that interrupted again and again and again. So in the e-commerce side of business, there's a 30 to 40% increase in e-commerce that's occurred in this pandemic period. It, from our perspective, does not appear to be abating. And so we've seen these shortages that first started on the consumer end with, just crazy shortages like toilet paper. And then that's worked its way into the supply base. So we've seen shortages and increases in paper cost, in everything associated with the lumber and the packaging side of our business. We've seen those shortages continue, and so we see that propagating into trucking and warehousing and to the ports. So as shortages started to prompt additional ordering, we know there's been phantom ordering in the ecosystem, and that's been driving additional volume and purchases and inventory shortages. And then as those orders then hit the ports, then there's port shortages, and we've seen carrier capacities be capped out and those kind of things. And then we're back to it again with basic products like microchips being in short supply and causing other additional knock-on effects. So this has just been a crazy ride. Very few still periods or calm periods, but a lot of rapids. And the ultimate result of it all has been is rising costs across the industry. And so this is quite a ride we've all been in, and it doesn't look like it's going to end anytime soon. Next slide. I want to speak to a couple areas of what I would call troubled waters. The first is Shipageddon. So Shipageddon is a term that came out of this last peak, where everything related to the delivery supply chain was disrupted. It first started showing up like every peak. We normally would see carrier capacity limitations or carrier caps, and we would normally see peak season surcharges coming out of the major carriers. This year, what we've seen is that those carrier caps continued way beyond the peak period, and also there are still peak season surcharges in place currently, and we're all the way almost to June. So it appears that all of the carriers are treating the shipping ecosystem as if it is at peak, which it continues to act as it would be in a normal peak period, but it's been extended. And this is an ecosystem that wasn't built to run at peak volume across the industry and across the ecosystem for extended periods of time. So we're seeing lots of problems. One example that I would tell you about that you may or may not be aware of, it has to do with the volumes that have pushed between carriers, and this has been part of the problem that we've seen. So during peak of this last year, there were parcel select induct international orders coming from Asia Pacific flowing into Southern California, and each of the what we would call deferred carriers, so those who are basically inducting packages into the U.S. Postal Service. So some of those might include UPS Mail Innovations, DHL E-commerce, Pitney Bowes Economy. These services that normally would be bringing those packages in at a discounted rate, they started to bog down. There was so much volume that they couldn't get the volume into the market, and those packages, the customers started to see their times in transit bogged down, and so they switched who they were bringing in their product through. So we saw volumes on the order of 1 million packages hand off between at least 3 carriers in Southern California, trying to get those Asia e-commerce orders into the country and distributed. So that's just one example, but we saw many of these types of examples. Another is major carriers putting caps on volume and then customers looking for other ways to deliver their products, ultimately pushing a large portion of those excess packages into the U.S. Postal Service. And it's we saw degradation in the service of the U.S. Postal Service, but not because they were underperforming, but really because the carriers had pushed all of this additional volume onto them, as opposed to take a hit to their own time in transit in their networks. If you're interested in learning more about that whole piece of things, the ship again, troubled waters, we have an article on our website. You can check that out. I have the link on the slide here. Next slide, please. The other area of troubled water is the labor disaster that we're currently in the middle of. And this is really unique because, again, it extends past peak. We're in this period where demand is up, and at the beginning of the COVID pandemic, there were a lot of workers who were afraid to go to work. So there was a decrease in available capacity in the labor market. But then we saw these follow-on activities of government stimulus and extended unemployment benefits. Then as we came into the new year, tax returns and another wave of stimulus. And so these waves, they're not just ripples at this point, they're rapids, and they're causing a great amount of disruption across the industry. Something else that's different is that we're in a multi-industry wage competition. So we're having people compete, companies and industries compete for labor at an unprecedented level. And so this wage competition is driving up labor cost. And it's also, the shortage is just a present problem that everyone's having to deal with. Again, if you'd like to learn more, we have a white paper coming up on the Visible website. You can learn more about that, what the causes are, how we're working to mitigate those in our company, and we think that many companies could follow a similar resolution. Next slide, please. So of course we're left asking the question, how do we respond? What do we do as we're facing all of these difficulties? And really, the answer comes back to the answer that we're always told, that we need to diversify to avoid risk. And it's really interesting because now all of the diversification, all of these strategies need to come into play to really mitigate the risks that we're facing in the industry. So some of that is geographic diversification. When we talk about reshoring or nearshoring versus offshoring, the option to have something closer to home is very important in terms of production and distribution. Secondly is having multiple fulfillment or shipping locations. So our customers have benefited a great deal by at least being in 2 locations. So if one location is having a severe carrier or labor problem, we're able to shift orders and volume to another market and another geography. By having that geographic diversity, then we actually are able to work around some of the problems. Many companies, including some of our customers, have seen their e-commerce, the e-commerce side of their business grow from less than 10% of their total retail sales to over 30% of their total retail sales. And suddenly the need to be omni-channel is paramount. The need to be able to get a strong e-commerce presence has become super important. So becoming omni-channel has been a push that many of our clients have been making. Also, some concepts like buy online, pick up in store, or pick up and drop off points, those kind of strategies become another way to succeed in this marketplace. Carrier diversification is something at Visible we always talk about, a multi-carrier strategy, and we've had several opportunities to use this strategy with our clients where a carrier has capped them and they're unable to get packages out of a facility, and we've been able to switch them to another carrier. But if you don't have relationships with multiple carriers, then you don't have the ability to shift those orders between carriers. And so this multi-carrier approach is something that's very valuable and important. And then the last is like the first, just that supplier diversification, the need to have more than one source as opposed to finding yourself in a sole source situation has always been an important diversification method, but it's becoming more important in a time when the risks are high.